Good evening, everybody. My name's Matthew Gilligan. I'm a chartered accountant and a principal here at Gilligan Row. And this evening we're presenting our seminar on property investment. But just a few housekeeping issues up front. If you need to use your phone, please don't use it in here. We'd ask you that you turn your phones off and all your beepers off because they interfere with other people. If you've got questions, you're welcome to ask them. This is an informal presentation and you're welcome to ask questions if you've got them. Questions liven things up, so by all means go for it. If you need the loo, we have one. You go out to reception and it's on the right, ladies and gents on the right at reception. So very easy format tonight, and I hope that covers everything off. So I'm a chartered accountant. I'm an active property investor and developer myself. I'm 18 years as a property advisor and chartered accountant. And I'm also, I guess my roots are in tax and legal structuring, and that's my day job, predominantly helping people set up their tax and legal structures. And secondary, I guess, is my property investment, but I do have quite a substantial amount of property around the country. And that kind of flows through the practice. We're all property people here at Gilligan Row. You know, my senior managers that manage our clients' affairs as chartered accountants, they all own investment property, make some good advisors. They're doing what you're doing, trying to make money or actually making money out of property. So when you're doing things, talking to our crew here, you know, these guys are speaking from experience, and so am I. I have made good money out of property, and I think that's another thing. Take advice off people that actually do it themselves and make it themselves. You know, there's lots of experts working out of textbooks, but those people often, when the cards go down, and they always go down, okay, there's always a crash in every property cycle. And those fly-by-nighters tend to shut shop and do something else. Well, actually, we get busier in the down market because there's a lot of money to be made in a recession. So I'm helping over 2,800 of our family groups through Gilligan Row crunch their property portfolio numbers and manage their affairs. Another person here at Gilligan Row who runs our financial planning division is a guy called Steve Stark. He's an authorised financial advisor, and he heads up the property coaching team here at Gilligan Row. So he's an experienced property trader and investor. Some of you will know Property Tutors, very, very good traders across the road. Sean Wood runs that company, and so they're buying and selling property. Steve, of course, used to be Sean's general manager over there. So Steve's now focusing more on the buy to hold long-term investment. So we're not really a trading philosophy in this practice. We have lots of our clients that do trade, and we thoroughly recommend Property Tutors for that sort of business strategy. But our predominant focus here is long-term investment, buy and hold. Another person who you'll see through the traps is Janet Zukoa, and I think she'll stop on a bit later tonight. She's one of our main presenters in our education seminars. She's a clever lady. She's an accountant and a lawyer. She's written some good books, and I'm going to give a couple of those books away tonight, Money Secrets 101 and Family Trust 101. She's all up and down the country. She won Corporate Trustee of the Year for our trustee division. I think it was all the way back in 2008. But we're the only company that won that in New Zealand, so we're good professional trustees. And so she floats around, and you'll probably see her here shortly. Thought I might show you some of my developments. These were in the last cycle, leading up to 2007. This is Central Otago, Lake Dunstan, 4 developments that I did down there. Here we have Cromwell, and if you go past Cromwell through the gorge, you end up in Queenstown. But if you head the other way, go straight up the Cromwell-Wanaka Highway, Wanaka's down this way. So Cromwell's sort of between Wanaka and Queenstown. And main development that I did was that block there, number 4 and 3. That all came as one parcel, about 400 acres on the waterfront down there. And I'm still doing the canal subdivision here. And then we did a couple of other little ones back here. So this is the sort of thing that I try and do in my property development affairs. So here's a block of land in Central Otago. as I said, Cromwell just there. And as you come down the highway, there's a nice sort of rural block here on the left. Good evening. Hi. Nice rural block here on the left. And what I tried to do to that was put a nice subdivision in. And little did I know that if you went down the corner here, around the corner and up the road, every greenie and environmentalist and developer hater in Central Otago, they've all culminated together about 4 k's up the road. So I didn't do my due diligence. And right on their road, on their backyard, I tried to do this subdivision. I think it was 1:60. And thought that I could demolish them with a big checkbook and the Environment Court. And in the end, we withdrew because we were going to lose. And the moral of that story is that, you know, property development is risky and it doesn't always go right, that's for sure. But we also had a plan B. And plan B was a lifestyle block or grapes or cherries. There were lots of things we could do with the land. So we had plan B, plan C. And we still sold it out. We still pulled, good money out of it. I think we made $400,000 selling that. And it was, it was about a 2-year exercise. So we still got our cost of capital back plus profit on top. And we got out with our pants on without any trouble.
What was the main opposition to it?
It was a rural piece of land that we tried to rezone high density. Yeah, we tried to rezone it. So it was always a long shot trying to go high density from rural zoning, but there were precedents in the area, and there was certainly demand for the land, so you could show that there was a good business case for it. But we got slammed. Here's another one. Just up the road a wee bit on the lakefront, and you can see that was the lakefront holding, and I'm standing on the land across the road that we also bought. And it's just useless rabbit-infested land, beautiful land, but doesn't really have productive use. These patches here you can see are geotech holes where we've been boring down to see what the substrate of the land is, to see what sort of drainage and engineering we had to do on the site. And you can see there's a piece of a canal there that somebody's dug out. And actually where this came from, of course that's Lake Dunstan. Good evening. You're well and truly in time. Come and grab a seat. There we go, thank you. So you can see this is Lake Dunstan. It's a man-made lake. So that was a big deep valley with beautiful apricots and peaches and things. And of course Muldoon, in the Muldoon days, they had Think Big, and they just slammed a dam in. This is before Resource Management Act consents and that sort of thing. So they just pushed it through, built the Clyde Dam, which is down this end of things, and dammed the whole lake. It took sort of 20 years to fill up. But now what was the top of the valley became lakefront property, and all of this rural land became, quite desirable. So we took that block and had a vision to put canal houses in 3 keys. So each unit has 1, 2, 3 keys in it, and then lease that back to a management company and manage it as a resort style accommodation. Everybody can have boats under their house with spa pools and saunas if they want them, that sort of thing. So you can see we've slowly been developing it. Again, we got absolutely clobbered by the GFC, but we were punching within our weight. We just stopped developing when people couldn't borrow to buy the houses off us. And then as the market's picking up, good evening, you're on time, that's okay. As the market's picked up, we're now selling more and building them again. So this is not for everybody. Obviously, you've got to have the finances to pull these sorts of developments together. But that's a pub, and these units have been managed by that, and we're actually getting strong demand for this at the moment. So we put all of these sections in around here, and they're all slowly being built out, and it's coming together well. So it was actually quite a big undertaking because we had to dig the land out. We drove all of the piles for all of the units, put all the services in, and then dug the canal down around the piles. You can't drive piles from a barge or a boat because the pile driver tips in and drowns everybody on the digger. Good evening. Sorry. No problem whatsoever. A couple of seats there. We're just at preliminary stages. So as we developed the site, we took all of the dirt we dug out over there, which was just a massive amount of dirt. I can't remember how much it was, but it's something ridiculous, like 1 million cubic metres of dirt. And we dumped it over here. So all of the greenies were, of course, attacking this, trying to stop it. And our risk on this development was not over here, because we had the right zoning for a canal subdivision. It was commercial zoning. But the zoning was actually dumping the dirt over here. That was the problem we had, but no one noticed that. Because to dump 1 million cubes or whatever it was over here on an iconic landscape, that's risky. So we were a bit nervous as developers. So we had lots of fights over here with the community and appeased and gave in on stuff. But this is what we were actually worried about. Because if they said, no, you've got to track that 10 kilometres up the road, that would have killed the profitability. You can see it's slowly come together across the years as we do it. So that's a little bit about some of the subdivision that I've been doing at Central Otago. I've also been doing it in Gisborne and some up north. 4 principals here. Steve Stark, he runs financial planning. John Rowe runs the business advisory services team, so he controls all of the tax returns and financial statements and traditional things that accountants do. Janet runs the trustee team, and I run the tax and legal team. So we're not a law firm, but we employ lawyers because we set up a lot of structures like trusts and I guess the focus of our business is making sure that not only are your asset protection structures in place, but your tax is also right. And we've found across the years that it's very difficult to get an accountant who's thinking about tax to talk to a lawyer who's thinking about completely different things, asset protection. And quite often the goal of the lawyer will be, for example, to put everything into a trust for matrimonial protection or asset protection. But the accountant's saying, don't do that because you'll lock the losses up or you'll cause issues with certain tax rules. So we want everything in the individual's name. And then yet another accountant will say, actually, don't put it in the individual's name. You're better to use a look-through company because they have advantages. So same question, how should we own our assets? 3 different answers from 3 different professionals. And what's driving it is they each have different goals that they're trying to achieve, asset protection, tax, and one of the tax guys is not so good as the other. So what you want to do is try and get something that's fitting together, and that's what my team does. They have lawyers and accountants working together. Most of them are BCom LLB. So we're going to be talking about financial things tonight, and I've got a disclosure statement to read to you. It's quite boring, I apologise, but here we go. The views and opinions expressed in this presentation are not intended to be individual advice. The views and opinions are general in nature, may not be relevant to an individual's circumstances, and constitute generic concepts only. The views and opinions expressed are those of the individual speaker and not necessarily those of Gilligan Row Associates or its employees, officers or subsidiary entities. Further, any views expressed in this presentation are done so under the exemption specific under Section 14 of the Financial Advisors Act 2008 for Chartered Accountants. Sorry, told you it was boring. Nothing contained in this presentation is endorsed by the Financial Markets Authority. Before making any investment, insurance or other financial decisions, you should consult an authorised financial advisor. Disclosure statements for advisors related to GRA, including Stephen Stark, are available on request and free of charge. So Steve is an AFA. He's authorised to give that sort of advice. Go see him if you've got financial advice type queries. So if I could just pause and ask you to turn to the person to the left of you and say, hello, introduce yourself, or to the right. I'm going to take my jacket off. One of the things that I've found across the years, is that I tend to find the best deals that I do through networks and people I meet. And the people that I meet that have things that I want to buy tend to be in networks like this, where you're talking to other property people, because people interested in buying and selling property come to things like this. No one else does. So it's actually a really good thing to stay and have a cup of coffee and talk to people in the room. It's amazing what people in a room like this actually own. There's people at all walks of life, people starting or wanting to get in, people who have made it and just wondering what GRA is saying, and people in the middle. And we know because we interview you all. There's people sitting in the room, and here I've had people in the room with 10 million plus of equity, and that happens at least once every second month. There's someone in a room that's high net worth, right down to someone that has gone bankrupt and is trying to get back and buy their first property. So real mixed bag. And so who you're meeting here are very good networks to actually meet and build. And I guess our whole practice is like that. I think we're over 3,000 families in our practice now that we act for, and they're all property based. A lot of them are self-employed, but the focus of this practice is people that enjoy making money out of property and paying less tax. So often we'll facilitate things for clients. If they're looking for something, we'll often know somebody that's got it, you know. So I would say to you, you know, you guys have given up the news and possibly some soap opera tonight. Is it Banshee? I think that was last night. You've given up TV or time with family tonight, and I'd say to you, why are you here? As a starting point. Why have you bothered to come tonight? Anyone? Not all at once. Knowledge? Yeah. You want some information specific to somewhere you're trying to get to? Or something that you're trying to do? Most people want knowledge, don't they? And I think that they would fit into one of these categories. You're interested in purchasing investment property, but you're worried about the market. You know, are we at the top or the bottom? Is it a good time to buy or not? Or you want to make some money out of property, but you just don't know where to start. Or maybe you feel you know a bit about property, but you need a bit of help taking the next step to get confident to go a bit further. Most people fit into one of those categories. And what I would say is I hope that tonight you'll see that we're actually practices deeply in property. We do it, we think about it, and you know, it doesn't matter what the market's doing, you'll see GRA out there and our clients out there, because we are the professional property accountants in town doing this stuff at all ends of the cycle. So tonight I'm going to share with you not only what we're going to be doing in this market and what strategies you should be thinking about doing in this market, but also let's start to think about what's around the corner and what you'll do differently around the corner when the market conditions change, because you're doing different things at different times of the market. What I would say is that everybody wants more, you know, but not everyone's willing to take action. So well done for getting off your couches and, you know, coming out tonight and spending some time to try and grow, because that's what actually tonight's all about. And well done for taking some action, because most people just sit and talk and never actually do anything. So what I would say to you is that we see property as a gateway to a better future. And I don't think you can necessarily say that through savings you're actually going to guarantee yourself a better future. But with property over time, there's no guarantees in life, but you certainly have a very good shot at it through property. And what I'd also observe is that I probably interview 300 to 500 people a year, and in years gone past it's been more than that. And wave after wave every year, up market, down market. Out of my 18 years doing this, I've interviewed a lot of people, 5,000, 7,000 people, something like that. So as you can imagine, I interview the bell curve. And quite literally, I can have a person who's on the rich list come in one day and, you know, discreet, low key, turns up, oh, hello, oh, yeah, I know you. And they want advice on something, technical advice. Very next person through the door is no net worth wanting to buy their first property. So we see the bell curve here. And every now and again, I bump into that guy or girl that's got 10 mil plus in equity, and I'm sort of thinking, you're too young for this. Because I just, you know, basically everyone fits into a pigeonhole when you've interviewed that many people. I look at them and say, you're too young for this, or I just say, you know, how'd you get this? There's a lot of money in my mind. Guess where it all seems to trace back to? 9 times out of 10. Property. I don't see that many people that make it out of businesses. Certainly business is part of the gateway, and you can certainly make a lot of money out of business, buying a business and doing it up and selling it, just like property. You know, you can repair a business or grow a business and sell it and make capital gain. But it's not quite so leverageable most of the time, because most businesses are small, whereas with property you can actually leverage an awful lot of money, and for that reason, anecdotally, we observe a lot of the high net worth people we meet, very successful people, they've made it in property, and you know, it doesn't seem to be so much the businesses that are getting it for them. So houses go up in value over time, just being very obvious about this. Someone else manages them, someone else funds them, And if you do it right and get enough of it, property opens the gate to financial freedom. So here's an example of a dirty old house of mine down in Otara in South Auckland. It's 12 Raleigh Street in Otara. And I purchased this for $227 last year, the year before now. So 2012, paid $227 for this. Spent $33 on it and renovated it. $260 was my total purchase price. It revalued immediately at $340. And so that was a 23% purchase price discount. So the difference between my renovated cost and the revalued amount when I finished was 80 grand, and that was a 23% purchase price discount. I actually borrowed $272 on it, because although I purchased it for $260, paid someone, good evening.
Good evening.
See if you can squeeze in down the back there somewhere. So even though I paid $260, I had to pay someone 12 grand to manage the project for me and do some, and a finder's fee to find the property because I was too busy to find it myself. It rented for $550 per week, and it's still rented. The tenant's been there since we rented it. The outgoings on it, including interest, are $21,000. The net cash flow is $4,600 after a 2-week vacancy allowance. So I'm projecting 50 weeks. So I get rounded up, I get a 24% purchase price discount, which is $80,000 the day I buy it, and it's producing cash flow of $4,600 a year, positive cash flow, and I think that's after tax. So there's my reno, instant equity. If I look at the cash flow side of it, there's the rent. I take off rates, accounting, property manager, repairs and maintenance, body corporate fee, and insurance. So this is a managed investment. Someone else is looking after it. So my total expenses are $5,000. I've paid $27,000. That's near enough to $22,000 as a net yield. I'm getting 8.4% as a net yield. Take off the interest, 6% fixed for 5 years at $272. And I know you're all going to say to me, oh, these numbers are out of date because it's 2014, the market shifted up, but that's what people were saying to me in 2012. So that's net cash flow before tax of $5,500. Take off the depreciation, I actually pay tax on the net cash flow after depreciation. And of course these days you can only depreciate chattels, you can't depreciate the building, so that's just chattel depreciation. So then take off a bit of tax on that, and then add take the after-tax cash flow and add back depreciation to get your total add-backs of depreciation and tax, to give an after-tax cash flow of $4,644. So putting it another way, I'm getting about $90 a week flying into my bank account after all expenses, and the instant equity on the property is 80 grand. It's subdivisible, it's 1,200 metres. So what's going up in value is not the one house, but the potential for 2 houses or possibly 3 houses on the site. So let's say finished, I could sell the house for, I don't know, $450, $475, a new house up there, $500,000 for a new house. I haven't looked into it. But let's say the finished house is $500,000 that I build, and I can do 2 of those. So my finished product is $1 million plus the original house. And that original house would probably be worth, say, $325, because I've cut down the size of it, maybe $375, something like that. So now I've got $1.4 million. What did it cost for me to build that? Don't care, because I'm not going to build it. The point is I've got potential land use of $1.4 million going up in value. So that property cost me $260, and I'm getting capital growth on 1.4, the potential land use. And what happens with subdivisible property is that you're getting more capital growth, because in 10 years' time, a developer comes along and says, well, this is a no-brainer. Those $500,000 are now $800,000. So I've got growth on the 2 $500,000 houses plus the original property. I'm getting massive capital growth. So instead of getting 6%, which might be what the area is doing on a single house, I'm getting 6% on 3 houses, yes.
Do you actually do the subdivision?
Might do. But I actually find it that a lot of the time the developers will come in at the peak of a cycle and pay you retail because the market gets silly. And if the asset's capital account, meaning non-taxable, because it's long-term investment, you're better just to take a tax-free gain, pass all the risk and hassle off to them. But I'm getting better than normal capital growth because I'm buying subdivisible property. And not every property I buy is subdivisible, but it's certainly advantageous if you can get it. And every man and their dog knows this. You all knew this before you came in here, but I'm just reinforcing that it's a very good strategy and perhaps explaining the numbers why you get better capital growth on subdivisible property, because actually you're getting growth on the end value, but you don't have to fund it. I don't have to develop it and manage it. I'm only managing one, but I'm getting growth on three. That's bank money that I borrowed to buy it, that's leverage, and the potential land use that I haven't even done, more leverage. So this is what we did to it for 33 grand. Now I remember my wife renovated my ensuite the year before last, still recovering, and she spent 33 grand on the ensuite, which I haven't forgiven her for. And we did a new kitchen, polished the floors, curtains, carpet, laundry, 2 bathrooms. And it's not beautiful, but it's okay. And then we renovated the garage and did some landscaping, did a new fence, painted the outside, which was brick, repaired the roof, did some wiring, And your money can go a long way is the point. But you've got to renovate to your market. Another comment I'd make is when I'm renovating in sort of medium to low end housing, don't go too high on your renovation standards because your tenants will trash your houses, And I don't care. I mean, I don't live there, but what I do care about is if I put too much money in there and they waste it by destroying it. So don't renovate too high. Expect them to demolish your houses because they're going to. And it's only numbers in a profit loss account and a balance sheet. You buy it for X, in 10 years you sell it for hopefully 2X. And if you spent too much on the house on the way through, then you don't get to keep the doubling in value. So do the bare minimum. And that's what you want to be doing. Don't spend too much because you're actually just giving away profit. So spend 260. We've got instant equity of 80, immediate annual cash flow of 4,600 after tax. And so since we've settled this property, that money's just kept coming in. It's nice to have that. The property is subdivisible. And the question I'd say to you is, how many of these do you need to retire? And, that's obviously subjective and something that you want to think about. And maybe property's not for you. You don't even want to do this. But if you are interested in property, how many of these do you need to do to retire your family? If you want 60 grand a year passive income, is that 12 of these? If you want, 100,000, is that 24 of them? Or do you instead need to buy 5, wait 15 years, let them go up with 15 years of capital growth, sell half of them and be debt free on the ones that you keep? Is that your strategy? Or a bit of both? And these are the sorts of things that we want you to think about, and we would encourage you to sit down with our AFA and make a plan. Most people live on the wage treadmill, and a lot of self-employed people are pretty much on a wage treadmill as well, because you can't stop work. If you stop work, the money stops coming in, so you're as good as the wage treadmill. So people want to get ahead financially, but they get trapped on this thing we call the wage treadmill. And this means you go to work every day and every week for an hourly wage, trading time for money. Never enough time or money, and I think most people would relate to that. What's smarter? Trading time for money or trading time for a profit? If you think about Raleigh Street, I think I spent about 4 hours on that property, and I paid 12 grand to someone else, which I borrowed, to find it and do the work for me. and so I didn't spend any time on it really, 4 hours, checking the invoices and writing the checks and reviewing the property when we first purchased it, and borrowed the finder's fee and the management fee, borrowed the purchase price, and got 80 grand and 90 bucks a week rolling in. And it's been going since I bought it. And I try and do one of those sort of every 90 to 180 days. There will be times in the market when you don't do it. And you're only going to do it if you can do good deals. There's no point in slamming deals that aren't making sense. But if you can tap into networks where you can find this sort of stuff, it's making you money, why wouldn't you keep doing it? So trading time for a profit is obviously a much smarter thing to do. Now Steve, who I'm going to introduce you to, hopefully he's going to turn up shortly, our AFA, he's my partner in this deal. And we got 80 grand instant equity and near enough 100 bucks a week pre-tax coming in. And we've had that ever since we did this, and it took me 4 hours and he did nothing. So what's our hourly rate on that? The instant equity is sort of 20 grand an hour or something, isn't it, 4 hours? So it's pretty good payday. Time spent 2 Saturdays, and in all truth I was about 2 hours a Saturday. So planning dinner versus planning your life and money, most people spend more time planning their meal and planning their dinner than they do actually thinking about this financial stuff. And you know, I love my food, and certainly love planning dinner as well, but this is, you don't have to do a lot of this. You need to get your plan set up, and generally one property a year for 3 or 4 years for most people, set and forget, wait 10 years, that will make a massive difference to your financial outcome in later years to come. So you don't have to do a lot of it, but you do need to get a good plan and some goals and execute it. So it starts with a realistic goal, and for, you know, everybody is different. Your household is different. Some people are double income, no kids. Some people are no income, lots of kids, and this stuff's dangerous if that's the situation. Some people are late stage investors, some people are early stage investors. Early stage investors have lots of cash flow, no commitments with the kids and things like that. They can take a little more risk than somebody who's a late stage investor who we'd encourage to be a little bit more conservative, because if they lose it, they don't have the time to recover. And then obviously people in the middle. So you need a goal that's scaled to your risk profile and your stage of investment. And you've got to have a time frame, because without a time frame, you know, there's no urgency to get stuff done. Once you understand that you're heading somewhere by a defined time frame, you can actually say, well, okay, that's the target. We've got to get there by this date. What do we have to do every year to get there? It starts to become much more tangible. And the next step of the time frame is get a series of logical steps based in mathematics to achieve the goal. Sometimes though, people come to see me and say, I'm going to buy 100 properties in the next 2 years. And we all know that's ridiculous and absurd. But they do that because they're not thinking about the mathematics, and their time frames are absurd and their goal is unrealistic. And so we would say to somebody with a grandiose goal, well, let's just break it down to a series of logical steps based in mathematics. How much cash flow have you got, and what can you fund? And let's stress test your household and make sure it's safe. What do you need at the end, and work backwards to what you've got now and see how much equity we've got to create in this time frame and what's safe to try and create. So put some maths around it and model it. Do a proper model of it. And that's a plan. So we would say, have you defined your goals? Look at where you are now and work out where you want to go and put a time frame on it. Get some knowledge on how to get there. We can help you with that. Put your tax structures in place, because you're going to need those. Get your finance in place, and then take your action and invest. That's the typical path that most people will go down. Pretty simple stuff. We have a product called Property School, and not everybody wants to go to school, but for people that enjoy learning in a classroom environment, Janet runs this great school called Property School, and the course is Property 101. And she'll go through with you in that course the basics of property, structures, finance, procurement strategies, and you'll meet people from our team through that course. It's a 6-week course, 2 hours a night. Really good course if that's the way you like to learn. And it goes a bit slower and it goes a bit deeper into things than I would tonight. One of the things that she does, and I think I've handed this out as a handout, is go through a thing we call bridging the gap. And what we're trying to do in sort of the first steps part of her property course is to get an understanding of what money you need to retire. And we run you through a worksheet process, and I'll show you how this works. So the first thing we get you to do, and I think, have you got this in your handouts there? Can you just have a quick look? Thanks. So the first thing we do is get you to work out what assets you've got now, and you can have a look at this a bit later. Let's just look at this conceptually. So this person might have equity of $250,000, that's assets minus liabilities. And then work out what they need at retirement. And this person might want a home and a batch, and let's say those assets add to $800,000. Clearly that's not Auckland. So their target's 800 grand of lifestyle property to live in, and then work out how much they need invested to get an income, a passive income, because having a freehold home doesn't retire you, does it? You need something to live off. So in this case, the person's decided they want 50 grand a year, and they've used a 5% rate of return. So 5% of $1 million is 50,000 a year. So they've assumed if they can get $1 million invested as a nest egg, have a freehold home and batch of 800,000, that gives them a target of 1.8. And if you then say, well, we want 1.8, we've got 250,000 of equity now, the gap's 1.55, we now know what the goal is to close, 1.55. And then say, well, how much time have we got to do this? Are you 40, trying to do this by 60? Are you 30, trying to do it by 45? You know, what's your time frame? If you divide the time frame that you've got to achieve your goal into the gap, then you work out what your gap per year is. In this case, 77,500. So how much do you have to earn to save 77,500 as a point of interest? Let's assume a average tax rate of 33%. It's got to be like, 110 grand or something like that, doesn't it? 105, 110 grand. But of course you've still got to live. So you need the 120 grand to run the household. So that means you've got to have the 120 to live, plus the 110 to save, you need 230. Not everybody earns $230,000. I'll tell you something about the people that I meet that earn $230,000. They spend $230,000, they probably spend $250,000. Because they send the kids to private schools, they buy Audis, they buy the new ones, not the second-hand ones. They buy a flash house in a flash area, and that's just something that comes with increase in income. You find your spend starts to creep up, and I think I read a book years ago, and they termed that affluenza. The more you get, the more you spend, and you don't get ahead. Some of the smartest, shrewdest, wealthiest people I meet are the people that keep their cost of living very low, and you would never think that they're high net worth, but their asset base is actually very high, and so they're saving everything, their investment returns plus their incomes, because as they get higher incomes, they don't spend it. But anyway, to close that gap of 77,500 a year, the point I make is most people won't be able to do that because they won't have a surplus after tax of 77,500 or 105 or 110,000 pre-tax. They just won't have that surplus because they'll need everything they earn to live. So if you can't save for retirement, how are you going to get there? So Raleigh Street in Otara, I bought that for $260. It's now $340. It revalued the other day. I revalued it at $390, I think it was. So I made 130 grand on that in sort of 15 months. It's paying me $90 a week. In 10 years' time, the valuation might go to, say, I don't know, 700, 750. So I get another 350 of capital growth, plus the instant equity I've made, plus the capital growth I've already made. Probably I'd have 500,000 equity in 10 years' time. I don't have to pay tax on it. So if I divide that by 10 years, it's 50 grand a year that I'm making, haven't put any money into it, hardly any time into it. So if I say to you, hey, you've got this gap of 77,000 a year to close, you're going to say, oh my God, how do I do that? But if you look at it, it doesn't take too many of these deals that you just set and forget to actually start to get ahead. Because the capital growth and the instant equity you get as you buy them, plus the cash flow you're bringing in, which allows you to pay the loans down, all of that stuff adds together and adds up over time. So here's a tool that we give to our clients to use, and we've got clients in the room, I'm sure you guys have seen this. And what we do is we model what you've got now, which is the orange line, and so that's just a statement of position, and there's a bit of science in this because it works out how much you can save, plus you can put your capital growth assumptions on your assets and work out how quickly they'll go up. So that's savings plus capital growth on your assets, and it's not just property, it's business, shares, chattels. So that's what you've got and how it's going to grow, the orange line. The green line is the target, and the tool will model what you need to retire. So there's cash flow and capital growth stuff in there as well. So if we then model the inflation effect on what you're trying to achieve, because that's always going up, and inflation on what you own, when one line crosses the other, you're theoretically retired. So this guy's 40, his target age of retirement is 65, thinks he's going to die at 80, retires at 87. Can anybody see a problem? And that's what I mean about using the maths, you know. It's very quick to reveal whether you're on track or not. When you're doing this, it's a self-drive environment, okay? So you put your own capital growth assumptions and you model your own cash flow, you do it. If you want us to give you a hand, we can do that with our AFA, and he can make sure that it's spot on for you. And it's quite inexpensive to do that. We can go to Janet's course, and Steve goes there and he runs this component of her course. So it's a good thing to do. So now what? Once you know the gap, what can you do to bridge the gap? And of course we say you can't save $77,500 a year. Most people don't earn enough to do that. So let's model what you're going to do differently, the black line. So this might be, and this is a different plan from someone else, but because this person's 50, and you can see that their theoretical retirement age is 94, and they're dying at 82, but now, by buying some houses, they're achieving, and they've probably reduced down their target lifestyle as well. So it's a combination of saying, well, let's be realistic and reduce the target and increase the amount of investment activity, and they're getting there by 66. So that's what we mean about having a time frame and making sure that the maths is adding up and making sense. So this is a typical investment strategy. Somebody will go and borrow some money, let's say $1 million to round it off. And we're not saying you go out, borrow $1 million and start spending it, because banks don't lend it to you like that. You go buy the first property, it's 260 grand, 12 Raleigh Street, Otara. It revalues to 340. You put a 20% deposit on it, 260, it's what, 52 grand? The bank then lends 208, you buy it, you reno it, you tenant it, you revalue it, the bank gives you the deposit back. I'll get the 58 grand back. Do it again. Do that 4 times. I've now got $1 million worth of property invested that is valuing at 1.2, roughly 1.25. So I've got 20% equity in it. It's 100% financed. It took me 3 years to do it, maybe, in this example. So it's not quick. But in 10 years' time, life changes for somebody that does that. And everybody says, gee, how did you do that? Well, it's not done in a hurry, I can tell you. It's done by forming good habits and continuing to do it through the down cycles and the up cycles. So you borrow $1 million. It grows to $2 million over some time frame, who knows how long, maybe 12, 13 years, something like that. Doubles in value over 12 or 13 years. People who say probably doubles in value every 10 years, I don't think that's correct. It's more like 12 or 13 years. Because doubling in value over 10 years means 10% straight line growth. That's too high. I mean, it has happened at certain cycles. The 2007 boom, things were doubling well and truly over the 10 years prior to that. But I think things went very high and it's a bit slower, and other cycles have been slower. But nobody really knows what things are going to do. But let's just say it's 12, 13 years, the million doubles to 2. So now, encouraged by your success, you borrow another 2 million, and you've borrowed $1 million back here, plus another 2 million, so now you've got 3 of debt, and the assets doubled and you've got 4 million invested. The asset you've got that's worth 2 plus the 2 million you just borrowed. And that doubles again, from 4 to 8. So now you've got 8 million worth of asset, less the 3 million of debt, and that's 5 million of equity. Took you 25 years to do this. Maybe it's 2 full property cycles. It's not that many properties, by the way. So it's a long time. It's a lifetime to do this. But everyone thinks that you're a genius because you've got 5 mil of equity. 5 mil of equity in 25 years' time is nowhere near as much money as it is now, isn't it? But it's still a lot. It's still a lot. So now you've got 8.5 of assets, say, 3.5 of debt and selling costs. So you sell down and you get this $5 million out. What do you do with it? You go buy the boat, the batch, the 2 cars, the family home, that's 2 mil. And you put 3 mil in at 6%, which is 180 grand a year, which is 15,000 a month. And you're getting capital growth on top at 7%, which is inflation protecting your wealth. Because if you earn 15 grand, give 4 to the government and spend the 11, and the asset you've got is, say, cash, which doesn't go up in value, next year it's only worth 3% less. So you're actually getting poorer. But if you've got a capital growth asset, the asset's going up in value, so inflation's not eroding the amount of wealth you have. So that's a good thing about property, is the capital growth of it is keeping pace with inflation or beating it, hopefully. No guarantees in life, but that's the idea of getting an asset like property. It's inflation protected. Does that make sense? Quite ethereal tonight, a little bit, bit of theory in it, but I think it's quite important to understand the big picture as well as the detail. So now you've got this superb position where you've got this cash coming in off your investments. It's inflation protected, you're freehold, you're risk free, but you took some risk to get there. Because that first million you borrowed was scary, and lots of people around the dinner table were saying, don't do it, it's crazy. So many people are anti-property, it's not funny. Let's look at what fund managers do with money. So this is KiwiSaver schemes and that sort of thing. But what they're doing is they're trying to achieve what the market achieves. So with a fund manager, if they were to get a 20% return in a year, everybody would throw stones at them and say, that's too risky. The market did 8% this year and they made 20. They must have taken an extraordinary amount of risk to do that. So they'd be criticised. Conversely, if they don't get what the market does, everyone criticises them for being mediocre. So what fund managers try and do is get a little bit above what the market does, but not too much or they get criticised or for being risky. So if the market's doing 10, they're trying to get 10. So how do they get 10? 10% growth? If telecommunications stocks are 20% and infrastructure's 10% and manufacturing's 30%, they buy stocks that match the market. And then they try and pick the better stocks within the market segments. And then they diversify regionally for currency risk and for economic differences between regions. So to do this, because it's quite complicated and there's regional knowledge that's quite specialised, the fund managers buy other funds. So they'll buy Asia Pacific funds with one manager. So you end up investing in funds of funds. And that's kind of an efficient way of doing it. They spread it out all over the globe. And so if half the globe's going down and half's going up, your average is de-risked because you're getting what the whole market's getting, and no one gets criticised because they're achieving what the market's doing. Make sense? That's the idea of diversification. So they might, for example, put 37% into property, 37% into shares, and 25% into cash for a bit of liquidity, because people want to take their money out over time. And it's also a risk profiling thing. They'll have some liquidity. So that's what asset allocation is about. It's about reducing risk, and that's the type of thing that fund managers do. And it's obviously more sophisticated than that. They have very complex models, but big picture, that's what they're doing. So let's look at what $1 invested in interest-bearing deposits does over 12 months. Let's say you put $1 into a deposit with the bank, and the bank agrees to give you 6%. It's $1.06 in 12 months' time, isn't it? So if you take off tax at 33%, that's $1.04 after tax. And then you take off inflation at 3%, you got $1.01. So if you spend the 4%, if you spend the 4% after tax, next year the spending power of your investment's actually gone backwards because you've spent the 4% and inflation has eroded the money by 3, so you're actually down to 97 cents. So if you do that for 20 years, you actually end up poor. Make sense? We call that wealth creation suicide. So cash in the bank, you need some of it to defend yourself, but it's dangerous to put all your money into cash in the bank. If you buy shares, let's say that shares do 9%. Cash return, the dividends, plus the capital growth. So in 12 months' time, that's $1.09. Take off management fees, $1.07. And you might say, oh, 2%, they only charge 1.3. 1.3 is after tax. The pre-tax cost is 2. Fund managers, they're pretty slippery. They'll say, this is our management fee, it's only 0.75. And you'll say, oh, is that before tax? Yes. Oh, so it's 1.1 before tax? Yes. Does that include administration fees? No. How much are they? 0.6. Is that the after-tax cost them or the pre-tax? After-tax. Oh, so it's 0.9. So it's 0.9 plus 1.1, that's 2. Yes. They're very slippery. And they're so hard to read, their statements. And then they have transaction fees. That's another cost. And they, take off tax. So we take off management, take off tax, $1.05, take off inflation, we're down to $1.02. So KiwiSaver funds have to do really well to beat this stuff. KiwiSaver funds tend to be a bit cheaper. You can get, 1% management fees on KiwiSavers. So that's $1, $2.7 after inflation. But still, it's not exactly fabulous returns. We call that more wealth creation suicide. So now let's look at leveraged investment. And let's look at leveraged property investment, and we'll have a made-up scenario, 8% capital growth over 10 years. So you buy $1 million worth of property, it's worth 1.8 in 10 years' time. And for every dollar you put in, the banks will put in $4. So you've borrowed 80% and put in 20%. If you think about that, your capital growth is not 8%. It's 5 times the 8%, because not only are you getting 8% on the money you put in, the dollar you put in, you're also getting 8% on the $4 that the bank put in. So your capital growth 40%, right? So let's factor this in. You get a net yield, and I'm going to say 6.5, that's rent less expenses. Take off management fees. Let's say that we don't pay tax because we're gearing and depreciation, so we end up paying no tax. And we actually go negative on cash flow. So we'll say, well, we've got to fund some cash flow to get this return, plus the capital growth, $1.40, take off inflation, $1.37. That slide's a really long-winded way of saying, buy a $500,000 house, put $100,000 deposit on it, in 10 years' time, 12 years' time, maybe it's worth $1 million. You make 500,000 gain, you put 100,000 in. 500 gain, 100,000 in, 500% on your money. That's the effect of leverage. If you put 500,000 of cash into equities, maybe they do 8% like property does, but you're getting 8% on your money. You're not getting, with property, if you put 500,000 in, you get to invest 2.5 million. You're getting 5 times the investment return. So it's a long-winded way of saying leverage is what really makes property so attractive. I'm not saying property is better than shares. The returns of property generally tend to equal the returns of shares. What makes property better is you can borrow money from the bank and get a return on their money. Does that make sense? Putting it another way, if you can buy property and have the money coming in equal to the money going out, the rent coming in equal to the costs going out of interest and expenses, you get free capital growth. And it's not your money, it's bank money. It's free capital growth on someone else's money. You're all suddenly looking tired. Can I get you to stand up for a sec? Can everybody just turn this way? Just give the person in front of me a bit of a shoulder rub for me. That's it. That's good. Now turn around this way, please. And give back exactly what they gave you. That'll be good. Very good, thank you. So I'll just remake this point. I'm not saying that property is better than shares or shares are better than property. It kind of makes sense because if property is doing better, everyone sells their shares and buys property. And because they compete, they pay more and more for the property, so the returns come back, so eventually the yield comes down. And then suddenly shares look better, so everyone sells the property and jumps back to shares. So and that's the idea of a perfectly competitive market, basic economic theory. With commodities like property and shares, the money chases the yield and it evens out over time. So share returns will equal property returns over time. But what lets a small household get ahead is the leverage, the fact that you can borrow money on the property. Now you're going to say to me, the smart cookies in the room are going to say to me, hang on a minute, Matthew, you can borrow money on shares in New Zealand and leverage shares. And that's true. But most people won't do it because when a share market crash happens, it happens so quickly. If you're leveraging, you can lose all your money very quickly. But with property, just hang tough, don't you? You say, oh goodness, here's my $4 million worth of property. I got a $2 million loan on it because I've been doing this for a long time now. But now it's only worth 3 because the market apparently is backwards 25%. And for a year or two, it's like that. So but property investors just don't sell. And because it's backwards, the people that are being sold upside down attract new blood in and it restarts the cycle. Because everyone says, here's cheap houses, we'll start buying them now. So it restarts and away it goes again. So you just hang tough through the low patch and if you are going to cash up, you cash up at the peak of the cycle. So there's this thing called an economic cycle that operates within an economy. And within the cycle, there's different growth stages. Boom, downturn, bust, recovery. These are, I think, common sense, widely agreed cycles of any economic cycle. And the period each stage goes through differs in time and length, and no cycle is the same. And I guess this is dictated through the scale of the actual economy in question and other forces on the economy. For example, in the European markets, in the European Union, you've got all of those European Union members with different interests trying to fight. And so that's completely different in scale and dynamics to, say, Australasia or Asia Pacific or America. So you've got to look at it as a very region-specific thing. But in general, things start down the doldrums. There's a bust. Think 2010. Things are at the bottom. And some people are saying, oh my goodness, a bust is terrible. Who would buy property now? Well, that's when I buy property. And then you go through a recovery because guys like me buy because we think that the asset's going to recover in value. So things go back up. And then eventually it gets quite high and you've got to look at it and think, oh, these yields don't make sense. The cash flow is terrible. The asset looks ridiculously expensive. I'm a bit nervous. I'm not buying. And then predictably a downturn comes and all of the skeptics and property haters say, we told you so. And assets crash in value and stock market people who are trying to get equity in the stock markets, often government people, are clapping their hands saying, we told you this would come unstuck. Well, yeah, we know too, guys. And then things have gone bust and things look cheap again and people start buying again and the cycle restarts. So that's an economic cycle, but it's also a property cycle. They walk hand in hand. So property's cyclical, and when you know the economic cycle and the property cycle within it, you can make particular decisions that are going to help you grow your wealth at different stages of that cycle. And we're doing different things at different times. Sometimes we do nothing, because that's the smart thing to do, or you bail, you know. At this time of the market, for example, I like to sell the worst assets I have, the problem assets, because there's always someone wanting to buy it, and if ever you're going to unload something that's a problem or difficult, you unload it now, in the middle of a boom. But you stick to your guns. I'll always buy, but I've got to get a discount, and I've got to get cash flow, or I've got to get some exceptional story to the property. There's got to be a reason why I'm doing it. So in the peak of a cycle, you know, you're doing different things to what you're doing at the trough of the cycle, when you might be saying, oh, well, everything's cheap. I'm going to pick the best quality assets, but I'm going to buy as much as I can because I know it's cheap. Local market conditions can change the cycles. So, for example, here we are arguably heading towards the peak in the next year or two. No one knows, but my opinion would be in the next year or two we're going to peak in Auckland. But there are things that can be happening, cycles within cycles, that change things. Now, let's talk unitary plan for a moment. Auckland is forming roughly, well, it's attracting 20 to 30,000 people per annum into the Auckland region as growth. And there's 2.5 people per household on average. So you're going to need somewhere between 10 to 20,000 households, depending on how many people per household there are. There is a trend towards less people per household, with baby boomers ageing and so forth. So you're going to need 10 to 20,000 houses a year to supply Auckland's needs. And you could say, well, that means we need 10 to 20,000 sections. But what our City Council have done is, through Len Brown, say, well, what we don't want to do is to keep sprawling, because that model of a sprawling city has failed in Sydney, London, Manhattan, New York and so forth, because the density of the population causes traffic congestion and lifestyle compromise and so forth. If you just keep sprawling, the road transport networks get completely cluttered. So what they're saying is, instead of going out and having a massive city, Los Angeles is an example of it, where the motorway network's always crammed, let's ring fence the city, say no more sprawl, go high rise, and put on really good quality urban transport. Now, whether you agree with it or not, who cares? That's the decision that's been made, and that went into the Auckland Strategic Plan, and that was 3 years ago. Now what they're doing is looking at the planning rules that give effect to the strategic plan. And there's about 22 of those different plans, but one of them is the unitary plan, and that is the developers' planning rules. And what they're saying is, I think there's 5 different zones, but the ones that we care about are the new mixed-use zones and the commercial apartment blocks that they're allowing to be built. And what was previously allowed for perhaps 1 or 2 houses, you can now put 5 houses on. And in some areas, on very small footprints, you can go high-rise with unlimited height, as long as you don't interfere with volcanic sightlines and things like that. So there's a few rules to it, but point is, the unitary plan and the strategic plan are saying we must go up, not out. Okay, so everyone knows this, you read it in the papers. But you think big picture, and you think, well, there's 20 to 30,000 people a year coming here. There's no more sections, or there's very few sections. 70% of the growth that the city's going to have is coming from within the existing urban footprint. So 70% of the new houses must come within the existing urban footprint. And what that means is we have to bring the unitary plan in, we have to go through the legal process of the objections that will come out of that, bind those rules, get the City Council to change their anti-developer attitude, adopt those rules and actually allow the developers to do it. And then, that's not the end of it, that's got to be 2 to 3 years to achieve that. Then you've got to say, well, hand in hand with this, if you're currently flushing the toilet down a pipe this big, and there's 10,000 people in that catchment, and we're going to put 30,000 into it, well, we're going to need a pipe this big. And if the telecom cable's this big and we're tripling the size of the catchment, maybe we need one this big. Basic stuff, right? So you could dig up all the streets, put new services in. And then you've got to put the rail and the transport stuff in as well. So that's all going to take time. So I think this is a pressure cooker, and in 10 years' time, everyone's going to look back and say, why the hell did we do that? Because we certainly have a great city plan, but the social cost is going to be house price inflation. And the average person who's trying to get into the market will find it very difficult because of the house price inflation. And then you add to that the cherry on top, and that is the Reserve Bank rules saying you've got to have a 20% deposit. In other words, you've got to be rich to do this. Maximum demand, a period of short supply because rules are changing and we're not giving any more land, and you've got to be rich to get in. So it's a pressure cooker. We're going to see growth in Auckland, in my opinion, very good growth, and it's quite socially regressive because poor people can't do it. That's the effect of what the government's done. Unless you've got 20% deposit or you know someone who can lend it to you or give you access to their house, your parents or your friends, you're not going to be able to get in and enjoy it. So I think what will happen is the politicians in a few years' time will say, how could this have happened? It was totally unforeseeable. Poor people have not been able to participate in capital growth. And they'll throw the rules out, the Reserve Bank rules out, because they'll be labelled socially regressive, and we'll see loose credit again, and then that will be the petrol on the fire, because house prices will already be expensive. So I know that's a fairly long view of things. Some might say that's a long bow, but that's what I think is going to happen. And I'm very, very bullish on Auckland. I reckon that you can't do better than holding your money up here. So these cycles, we know that things are different at different stages. During the boom phase, share prices are peaking, employment is rising, finance is loose, property volumes are up, property values are rising, rental prices are up, interest rates are increasing, but they start low. And then, as we head towards the downturn, these rate increases plus share prices falling leads to property returns have fallen due to increased interest rates, rents have levelled out, money's harder to obtain because the banks are getting nervous, the volume of property listings grows, but they're not selling, and it takes longer to sell the property. And now we're sort of heading towards a bust because the market starts to get a bit fearful, as this is reported in the paper. And we start to see property prices drop, unemployment starts to grow, interest rates drop, and you see property returns increasing because interest rates are lower. And share prices start to rise. So you know you're heading towards recovery, finance gets easier, property sales start to grow, rental prices commence ascent, and your property sales and prices start rising together. So that's kind of your full cycle. Where are we now, do you think, in that cycle? Here? Up here and sort of here, or over here? Up here? Yeah.
I'd like to say it might be slightly different in Auckland to other places.
Yeah, good answer. It's regional. Yeah. It's regional. Because, coastal property is starting to go, but only just.
And Wellington's flat.
Wellington has been flat, starting to go. Yeah. Kind of last year got some growth. I've got some numbers on that here. Regions, some regions are firing, others are still dead, absolutely donkey dead. In fact, declining. I've got some land up north. I didn't think it could go any lower, but it's just sinking. But my rates bills keep going up and council keep increasing my CV, Warren Buffett, let me tell you how to get rich. Be fearful when others are greedy, be greedy when others are fearful. Clever words. Thinking about this, there's 4 ways to make money out of property. What are they? We kind of discussed things I'm doing, but there are 3 obvious ways that I've been making money, and there's a 4th one that's slightly less obvious. What's the first one?
Development.
Property development. That's the 5th one. Let's go for the first one. Okay, cash flow. Raleigh Street, money in, less money out. My rent's 27, my expenses are 22, I'm plus 5. So I get $100 a week coming in. I'm getting cash flow. What's another way? Leverage. High level conceptual one. Yeah. Capital growth. Yep. Capital growth. The asset's growing in value over time. How else did I make money on Raleigh Street? I made it when I bought the property. And that's what? Dead right. That's what? Instant equity, right? So when you buy, you can make some money immediately. And then it goes up in value. That's capital growth. And while you're doing that, you can have some positive cash flow. You don't have to get the trifecta. You don't have to get all three, but it's nice if you can. And there's a fourth one, and that is you can also be trading houses, buying and selling them, which is a bit more advanced. And there are tax issues, and it's much more sophisticated, and it's certainly not for everybody. But when we're working with clients doing this, we encourage them to go see the property tutors boys, because that's what those guys are really good at over there. Property cycles tend to run sort of 7 to 8 years, and then that's from boom to bust. So if you say, well, okay, peak to peak, we know we're going to have a crash in the middle of it because it's part of the cycle. In 1999, if a house was worth $200,000, and in 2007 it was worth $400,000, what's it going to do over the next cycle? That's kind of what we're investing in. Would the house in 2015 be worth, say, 700? And you'll see on that, I'm using 300 grand growth on 400, which is 7.5% straight line. So I'm not saying 10%. It doubled in the last cycle. I think it'll be less. And I think that those growth rates do tend to taper off, but you still keep getting growth. So during this boom phase, 99 to 2007, of the 4 ways to make money from property, during that phase, where things were doubling in value, how were people generally making money during the frothy capital growth phase? Because thinking about it, it's pretty hard to buy property at a discount during the capital growth phase because everybody's buying it. You turn up to an auction, a mortgagee auction, there's 200 people at it. And you're thinking, oh, bargain might be 250, market value 320, I'm going to bid 250, and someone pays 380. You know? And everyone shakes their head and says, what was in that person's mind? Was it emotion, or do they know something we don't know? And then 2 years later, it's worth 420 because everyone's buying, anticipating growth. So typically, to get into that market and make money, you've actually got to have some capital gains, and that's where you're making your money. So investors had to wait for their gain during that period because it was hard to actually make money out of capital gains. You could be doing something else there. What would that be? Trading. Going in and out. Buy a property for 260, you know, like I did Renovation, and flick it for 340 and take the 80 grand that I could have cashed up the 80 grand on Raleigh Street. And if I did that, I'd have to give half of my gain to the government for GST and income tax. So I don't like doing that, so I'd rather hang on to it. And lo and behold, 18 months later, it's worth another 60 grand or whatever it's worth. And in 10 years' time, it's worth another 500 grand because it's subdivisible. So I'd rather have all of that and not pay tax on it. Unless one thing happens. What's that? Who's going to remove our capital gains from being tax-free? Labour. Yeah. So if you want your capital gains taxable, vote for Mr Cunliffe. I really don't care what government's in, as long as they leave property gains alone. Of the 4 ways of making money from property, how do you make money during a slump? What are you getting during a slump? Cheap deals. So in my rule of 3 ways, what do I call that? If you get a cheap deal, market value's here, you buy for here, what's that bit called? Instant equity, isn't it? Purchase price discount, instant equity. So during a slump, you're getting the hell deals because you're turning up to the mortgagee auctions and there's not 200 people or 500 people, there's no one there. And I remember in 2009, when I was reading blogs online about the collapse of the fiat currency and banking systems globally, and doomsday stuff. It was pretty scary. And then the official cash rate of America was 0, and New Zealand's was what, 2% or 2.5%, whatever it got down to. All that stuff, it was scary times. I was buying assets that previously I couldn't get access to in the boom cycle, and so were all of our clients. I was literally in mortgagee rooms, and I'd say, "Oh, there's Sean, there's Steve, there's my clients." Knew everybody in the room, apart from the agents. And you could be picky. Great time to get hot deals, and you can get access to better quality assets that some poor person's paid double what they should have, and a bank just says, "Throw this out." I bought an apartment in 2010 for 40 grand, and it was leaking, and I figured that it would cost about 20 grand because it was only a window, and there's no cantilever decks or anything like that, and it was a concrete construction. It was just the flashings on the window, but it was high rise, so it was expensive to fix. So I figured, well, it can't be more than 20. So, and the person before me paid 190. So I thought, well, 40 plus 20 to fix it, that's 60. And then the building will get code of compliance and it'll be worth 190 again. So, of course, in 2009, 2010, banks hated apartments. They wouldn't even lend on them. You could borrow 0% on them. So you had to be a cash buyer. The only things they hated more than apartments was what? Leaky buildings. So leaky apartments were pretty tough. And so there's a property crash, there's a leaky building, and it's an apartment. There's the trifecta of distress. 40 grand. It did cost 20, but the building sued council and they paid for it. So I got the building for 40, I got the apartment for 40, it's been rented since I bought it, and my net yield's about 12 grand a year. So 12 on 40, it's like 30% or something net yield. So it's a nice cash rate, and now it's worth 190. So you get 150 grand, recovery in value. I've done nothing. Sign some bits of paper and get the bank to give me the 40 grand. It's paid off on principal and interest. I stuck it over 5 years, so it's nearly paid off. Easy money. Another one I bought in town, 37 Simon Street, some very nice building actually, the Forte building, if anyone knows that building. And I paid 95. The guy was going bankrupt. I met him at a network thing like this. And he said, "Oh, I paid 269 for this. The bank will take 100. And I said, "I'll tell you what. You get the bank to accept 95 and I'll give you the 5, because he was going to Australia. And of course, if the bank had taken the 100, they would have got the 5. They wouldn't have given him anything. They hated him. And so, done deal. I give him the 5. He gets the bank to sign the agreement off. I get the apartment for 95. Net yield on that, it's been rented at sort of 350, 360 a week ever since. Never had a day of vacancy. I think I'm getting 12% net on that property. So after expenses, I get 12%. I've borrowed at about 6 all the way through, so I'm plus 6%. $500 a month coming in ever since I bought it. Assets now worth 200 plus, probably worth 250, something like that. So it's free money. It's just free money. Now those deals aren't around at the moment. There's no instant equity. There's no distress. You can't do that easily. I certainly can't find those deals. So I'm not saying to you, hey, here's this mirage of wealth. It's not there, because that's slump stuff. But what I'm saying to you is, you want to be doing this in the next slump. You want to be talking to us. You want to stay in touch with us and get into our networks, because we're continuously investing. We're just doing different things at different times of the cycle. And that's what you want to be doing, forming good financial habits and doing this stuff, continuously. Just do different things. So here we are. We're kind of here, aren't we? That would be my feeling of it. I reckon we're 2/3 of the way up at least. And I think that locally we're going to get some real bonuses out of the unitary plan. And Auckland's really maturing as a city. Everybody's coming here. So it might go further than we expect, like it did in 2007. It might catch us out and go a bit higher than we think. But I certainly don't think we're at the top. And I certainly don't think that we are in the middle. We're between middle and top, somewhere in there. That's just my view of it. And I reckon that, therefore, you've got to be adopting trading strategies as a good, clever strategy, or you just be a little cautious because 2/3 of the gains have come, and you might find that you buy now, hoping it's going to go up another 30% or something, and maybe it goes up 25, but then it comes down 25. So in 2 years' time, you're in the same position as you are now, maybe. So there's no urgency, be picky. But what I would say is these Reserve Bank rules have reduced liquidity in the market. There's not as much money around. The banks can't lend, they're not allowed to. So those with money at the moment have got a bit more of an advantage they had, especially with investment property, because that's a little bit less liquid. So there's a few deals around. I think I've got a couple here to show you that I bought in the last 2 months. So these Reserve Bank rules have sort of spooked the market. And when they announced them, things really died. It was, lights went out for a little bit. And I snapped a couple of deals, I'll show them to you. So what are we investing for at the present? Capital growth and trading strategies. Because you don't get instant equity. I have been getting some, and I know that some of my clients in the room are getting some, but it's not easy. So why is growth important? Well, somebody mentioned that Wellington hasn't grown. Since 2008, it's grown 10% and 5.2% last year. So compare that to Christchurch with the earthquake, obviously. It's up 26 since 2008 and 13% last year. And Auckland, 15% and 40% since 2008. So why are capital growth rates important? Well, if you had $1 million in Wellington, now you got 1.1 in that time frame, and in Auckland you got 1.4. That's why it's important. 4 times the return. And putting it another way, if you had bought in, say, Whangarei, Whangarei's still going down. I'm not going to get into Whangarei. I love to get into Whangarei, but let's get into Whangarei. I couldn't think of a worse place to invest in Whangarei. Supply and demand is fundamentals, okay? So up there, nobody wants to live there because it's not a good place for employment, and lots of people don't necessarily have a goal to live in Whangarei. Let's just leave it there. But on the supply side, so there's no demand. No one wants to go and live there. Very few people do. The population is not growing. But on the supply side, you've got 20,000 sections consented in Ruakaka. So at 2.5 people per household, that's 50,000 people. So they've got a city the size of Whangarei consented right next to them, which is an abundance of land supply that will forever oversupply Whangarei. And nobody wants it. Or there's not growing demand. So that's why I say Whangarei is such a terrible place to invest. And it was totally foreseeable. I went up to the Property Investor Association in Whangarei back in this time and said, God, the elephant in your backyard is this oversupply of land coming, sell all of your houses. And their house prices were quadrupling in value because rural New Zealand went from 40 grand a house to 160 back in that cycle. So they were all thinking that things were just going to keep going up like that. So many of those people went broke because they bought 40 of these houses, used leverage, and now the assets are crashing back down by 50%, 60%. So that's why capital growth rates are so important. If you're not reading the market, you can actually go backwards and out the back door. You need to be in solid demand areas with limited supply. That's where you get your growth. So financial plans. You wouldn't expect to fly a plane without some training. You can go and buy a plane, you can go and get a Cessna for 100 grand, but if you jump in it and take off, you might crash. You need some training. Building wealth is no different. And to decrease your risk, you need knowledge and assistance. So build your team of specialists and get people with new knowledge to give you a hand to reduce the risk. Steve Stark, who I'm hoping is going to turn up shortly. He is an authorised financial advisor. He's got extensive experience in property. He helps our clients plan their money futures by doing financial plans. And this includes looking at their debt, their structures, and ways to improve their financial life. Most services related to property are just trying to slam deals on you, and the vendor is making commission. We don't make commission out of property here. We have no property commission. We're a fiduciary-based organisation. We make money out of charging you for time or charging you to do things like set up trusts and stuff like that, do your accounts. So when you go and see Steve, he's got no agenda to flog your property. His sole agenda is to say, what can we safely do with your household to maximise the returns in the next 10 or 20 years? That's what he does. And what he'll do is go through a very generic financial planning process where he does a fact find, gathers information off you, analyses the information, makes some recommendations to you, take action. He then holds your hand, tracking your ongoing process, and says, okay, this isn't working, this is working, let's reorganise things and keep repeating this cycle. So our goal is to spend more time with you over the next 10 years and help you actually achieve the targets through this planning cycle. So if you want a financial plan and you want to implement it, you can stick it in our cloud-based financial planning software application called Life Online. I've shown you the modelling of wealth. Steve can do that with you. You can run your deals past Steve. He's a good investor. I buy and trade with Steve. He's very good. And you can come to monthly coaching sessions with Steve. Half the battle with property is staying in the game, because you try for 3 months, don't get anything, and give up. And because you get bored, or you lose interest, or something else takes your attention, death in the family, overseas trip, whatever, you just fall out of the habit. We can give you momentum, because we can say in the next 12 months we're going to do this and keep you accountable to the goals that you're making. And it's not 1 to 20, it's 1 to 1. Okay, it's 1 to 1. If you want group stuff, you go to Janet's property school, and you can do that and be coached by Steve. So you can get the big picture stuff, but bespoke 1 to 1 advice. We have 2 options, you drive or we drive. You drive means you're doing it, we're supervising. So we do the plan, you do it, and we supervise. We drive means we do the plan, you sign it off, and we then find the properties for you. We go to real estate agents and property finders that we know that are investment focused. They will charge you a fee. Okay? We don't touch it. We get nothing out of that deal. We only recommend the deal if we like the deal. Sometimes we're dealing in private networks. We know when people are going broke because they come to us for help. Sometimes we'll say, you need to talk to you. Everyone go away and take independent advice. Deals get done. One organisation we do really well with is we've got a church in South Auckland, and the pastors bring us their members' deals when the members can't pay their bills. And we grab the houses. So, and we give the church a donation. It's all above board, everybody can see what's going on. And we get deals through this church because they bring their members to us who are insolvent, can't pay their bills, lost their jobs, going to be turfed out. Or would you like to rent the house back at this price? We'll buy it off you for that. Are you happy? We get deals like that. Thank you. What sort of tools do we use? Well, you've seen this Life Online tool. You've seen the graphs that I've been producing. And what you can do is you can, when you're looking at a deal, key it in, look at it as a buy and hold, look at it as a trade, look at how it would look in your portfolio, and track that to your plan, your financial plan. It all ties together. It's called Life Online. And it's massive cost. Firstly, you've got to become a Gilligan Row client in some form, either with Steve or with our accounting practice. But once you've done that, it's free. We'll give it to you. Okay, we built it in 2008. It costs us nothing to run it, because once we built it, it costs us nothing. And so for us, it's a sort of give back to our client base and a point of difference. No one else has got this software. It's very comprehensive. Is anybody here on it? So our market share is not very good then. It means we've got lots of market share to get. Well, it's free, so make sure you take advantage of that. So it looks like this. You store your photos, your sale and purchase agreements, your registered valuations. You model the property, and I went through it with you. Your cost, work out your instant equity, your cash flow, your rent, your expenses, your cash flow. So you model all this stuff and say, do I like the deal? If I like the deal, you buy the deal. Now, when you're modelling the deal, this button comes up, email this property. You press that, you key your advisor's name in, say, hey, I'm looking at this for 227, the market value is 340, put their number in here, please review this, Steve, Matthew, click email a report, goes to Steve, Steve looks at it and says, hey, this is a good deal, this is a bad deal, and depending on what professional relationship you've got with him, he might go out there and look at it and Then we would bring in other tools we've got, like iAdvise, which is like Property Guru. You can analyse the online information, so you can work out how much it's previously sold for, how many times it's been on the market, what the names of the real estate agents are that have been marketing it. So the current one is John. You ring Marie, the last one. Hi Marie. Hey, what happened with this deal? You lost it. Matt Gilligan here. What's going on? Oh, that vendor's completely unrealistic. Go on. You know, yes, well, they need to get real because they've actually got bank pressure on them. All this information pulls out. So you go back through the prior real estate agents who are affronted because they never got to sell it, mine all the information off them, and you'll see each sales campaign it's coming down. They're getting more and more realistic. Who owns it? Is it a trustee of a trust? Is it a lawyer? Is it a deceased estate? How long have they owned it? What did they pay for it? All the stuff's at the click of a button. We have these tools. You can buy them and use them yourself. It's an online application, or if you're using us as accountants and property advisors, we can bring it up for you on the screen and give you a hand. And that means that the information you're keying into the portfolio is not garbage, because what you don't want is garbage in, garbage out. Spreadsheets can say everything, can say anything. You've got to put the right information into them. Here's another one that I did just before Christmas with Salish. Some of you will have Salish as your property accountant here. Salish Chen, good guy, just through this wall here. So he and I did this together. This is 182 Shirley Road in Papatoe. So we bought this in Bravo Charlie, which is our new company. We paid $388 for it. We spent 10 grand renovating it, so the actual purchase price is $378 plus 10. And the market value on it, when I bought it, I put $480 on it. That was my feeling that it was, and Salish's feeling that we thought it was worth about $480. It's just around the corner from the hospital out in Papatoe there. So we thought 100 grand purchase price discount. And the debt was $378 because we 100% financed it. The rent's $30 because it's a 6-bedroom property and 2 dwellings. So it's positive cash flow, 3.5 grand on current interest rates. So 30 grand, less expenses, 3 grand positive cash flow, after tax cash flow with a bit of tax back is 3490. The rent covers everything. The debt is 100% financed and we're still getting 3.5 grand cash flow. So that was, I think, August, September, October, somewhere in there last year. So right in the middle of this boom, when you can't get discounts and you can't get cash flow, there's that asset falling out of the tree, bought off a real estate agent around the time that those low equity rules got announced. I think good deal. 3 Jody Blaze Flat Bush, we bought that, and again it's Salish and I, we paid $370 for that. This was a hell of a deal. We spent 10 grand on it, 380. Market value we thought was 475. So again, 100 grand discount, 100% financed it. It's a 7-bedroom house in Flatbush. I like Flatbush, I think it's a good investment area. 32.5 is the rent, and positive cash flow is 2.5 grand. So cash flow is not epic, but it's a 7-bedroom, good quality house in Flatbush, which is a good area, right? So the valuer came in, and he said, I think it's worth 455. And this is Marsha Irwin, who, if you know valuers out in South Auckland, they're pretty conservative. So we were a bit annoyed with that because we thought it was worth more than that. So we spent 10 grand on it. Worst renovation ever. Absolutely horrendous, which Salish excels at. We put new curtains into a 7-bedroom house with a lounge and 2 bathrooms. What would you expect that to cost? 7,000? Well, if it was my wife, it'd be 70,000. $500. And this, I love Salish for this reason. And the tenant came in and said that the curtains were absolutely magnificent. It was their favourite part of the house. So you've got to watch it, because if you put your own values, onto tenant housing, you can completely misread the market. They're happy with $500 worth of curtains, and you spend 7 grand. You've got to be very careful not to overcapitalise. I don't know, there was stuff left over. By the way, they don't actually function. There's no thermal value to them, so the house will freeze, and the light just goes straight through them. And I think you can see through them as well. The tenant's very pleased with them. So and the valuer came in. We spent less than 10 grand. It's about 9,000 and something, and he said, "Oh, this is worth 500 now." And the tenants moved in. They're happy. So we're positive 2.5 grand cash flow. We've got 378 all in. So that's 120 grand. So that was November, December deal. So that's pre-purchase valuation, 7th of November, and we'd renoed it by the 9th, and the tenant had gone in the week after. Easy money, right? So you're starting to do the maths on this. It's just, there's always seems to be $80,000 to $100,000 of low-hanging fruit. It's just time to go and pick the fruit and learning to do it. Now, I'd go faster if I could, but this is the amount of time I've got. And you'll notice one of the things that I'm doing is collaborating with other people because I'm really time poor. But those people that are doing these deals, that are finding these deals for me, they've got no money. So they're very pleased to get a cheque from me to do the finding, because I pay them to find the houses. So it's just about being smart with your time and resources. And that's how the cash flow comes about on it. 32.5 is the rent. We've got a 2-year tenancy agreement locked in. Our interest rate's at 6.7, it's a bit higher, so that's why our cash flow is a bit lighter, because the interest yield is back because rates have gone up. Notice we lock in for 5 years. We could have got a 3-year rate much less, or we could have gone a third at 6, a third at 5.5 floating, a third at the 3-year rate and a third at 5. But our view of it is, well, 6.7 is cheap. We don't want to think about this stuff, so we lock it up. You can go and get advice off a financial advisor about interest rates, but that's the way we do it. So a question for you, how many of these deals do you need to retire? I asked you that earlier. That's something you should find out. You should model these houses and work out how many of them would actually get you to where you need to get to. So build your property on cash flow principles, but don't forget capital growth. You've got to build balanced portfolios. I've been showing you cash flow portfolios. Negative gearing is not recommended unless you've got an A+ property for capital growth and you can afford it. So, you know, if you go and buy a house in Herne Bay, in 10 years' time, it's probably going to double in value, because Herne Bay probably will get 9 or 10% straight line growth. Such an exclusive, high-end suburb. Rich people want to live there, and they don't mind paying 8% more or 10% more each year, because it's just a sought-after destination location. And Auckland's kind of heading the Sydney way, isn't it? Where waterfront houses are going to be $20, $30, $40 million over the next 10 or 20 or 30 years. There's already houses of that value in Auckland. So that's where it's going to be, areas like Herne Bay. Problem is that when you spend $4 million, you're lucky if you get 2.5 or 3 grand a week rent. So you're getting 150 grand on a $4 million investment. It's, 3%. 3.5% gross yield. Take off 1% for outgoings. You're really bleeding, aren't you? So you can't have a Herne Bay house in a rental portfolio because it doesn't make sense on a cash flow basis. So what you've got to do is look at the pre-tax and after-tax cash flow, but also think what happens to people that just have cash flow assets. South Auckland and apartments with low capital growth rates or lower capital growth rates. I happen to like South Auckland. I think the capital growth is going to be pretty good. But let's say you go buy bargains in Whangarei right now for the cash flow that's up there because people are bleeding, so you can get stuff cheap up there. What's the value of Whangarei in 10 years? Is it the same value as it is now because there's an oversupply of housing in sections? Probably. So you get no growth. So therefore you get this paltry amount of cash flow, you tied your capital up there and you didn't go anywhere. So you haven't actually gone anywhere. So you've got to have capital growth in your portfolio. So what you might want to do is go and get some cash flow assets, South Auckland, West Auckland, money in, less money out is paying you. And you're getting some capital growth in those areas. And that might be off 3 or 4 or 5 houses, it might be 20 grand, positive cash flow. And then go and buy yourself a fat capital growth asset in the bays, in Remuera, in Papatoe, that's going to do better, and it's subdivisible, and it bleeds cash, minus 20 grand a year. So you might have $1 million here going backwards 20 grand, and $1 million here going forwards 20 grand. Overall, it's break-even cash flow. But in 10 years' time, half your portfolio went through the roof, and the other half went up very nicely. That's called a wealth wheel. Now, horses for courses, not everybody's going to do that, but that's a good strategy. You know, maybe it's 2 of these and 1 of those, and these are Manurewa and that's Papatoe. Maybe that's where you're at. You know, just scale it to what you want to do and where you're at. And those are the sorts of decisions and thinking processes you'll do with Steve. This is called a wealth wheel. You need good finance structures. You've got to manage the banks to avoid crashing during a market crash. And when you're dealing with banks, obviously we need the money for leverage. Without leverage, you're only getting a return on equity. You need a return on capital plus the bank debt. That's the whole concept of leverage. So not only a return on your money, but a return on the bank's money as well. But you need to use the right structure to protect yourself. A lot of people I meet have done this, and it's not the advised way of doing it. Now, kind of ignore the business trust and all that. We've got a company with some rental properties in it, and a family trust that owns your family home. And the investor's gone to the bank and said, can I borrow $1 million to buy these 3 houses? And the bank said, sure, but we need 20%. So we'll just cross-secure your home to the rental properties in the rental company. So everything's tied together. So although they've lent 100%, the bank's happy because there's equity in the home which they secure the rental portfolio debt against. What happens if the 3 houses turn out to have P-labs in them, because it's a very unlucky investor, and they burn down uninsured for some reason? Can't think of how that would happen, but let's say that happened. This bank's now very upset, and they go back and say, well, we'll just take your family home out of the family trust, because we can, because we have a cross-security. So cross-security is a cancer in your structure. You've got to get rid of it. Don't fall into what we call a banking trap, which is a cross-security. So what you want to do instead is use 2 banks. Bank 1 takes security over your family home and lends the $200,000 to your rental company. Bank 2 lends $800,000 and takes the investment properties. So practically speaking, you bought the first house, you drew down 67 as a deposit, and the balance came in off this bank. You bought the second house, another 67, so you put 3 deposits down, drawn off your family home, but you borrowed in the company name, because that gives you deductibility. So you borrow in the company name, but secure against the home. This one over here, again you borrow in the company name, but you use the rental portfolio as security. Now, 80% of your debt is on the risk side of the wall, locked away from the trust. This is where we store wealth. This is where we conduct risk activities. So 80% of the debt is now ring-fenced away from the family trust and the family home. Much safer, right? Maximum exposure, 200 grand. Now we go back to the bank and say, hey, these assets have gone up in value. They're now worth 1.25. We renovated them. And you've seen me show you a couple of them that I've done. You can, you know, they've gone up in a month, it seems, less than a month. Jodie Place, revalued from, well, we paid $378, renovated, and it's $500. So, you know, you can go back to the bank and say, we want to refinance. Now, the banks generally want to see 6 months pass before you can do this. So anyway, you go back to the banks and say, this mill's now 1.25, revalue it up, it's now worth 1.25. So you go to bank 2 and say, give me 80% of 1.25. How much is that? How much? 1 mil, well done. You can have Money Secrets 101. Signed copy from Janet. That's just to encourage you to go faster. It's a good book. Family Trust is the next book I give away. So you have 800,000 with them. You borrow $1 million, so that's plus 200. So you draw down another 200. What do you do with that? Pay that off. It's gone. Now you're 100% financed, and they've got no redress against your family home. So now it truly is from a capital exposure perspective, a risk-free return. The capital growth is free, the money in equals the money out, the capital growth is free and it's not exposed to your home. What the bank can do is embarrass you by bankrupting you, but they can't pinch your family home. Now when you're in that situation and you have a serious financial problem, guess what? The bank has a serious financial problem. Because you can keep sitting in the family home and say, hey, I'm awfully sorry, I'm terribly embarrassed. Can we call it 10 cents in the dollar? So that's why you're doing this. You're putting yourself in a position where if you have a problem, you can negotiate with the banks and they can't clean out your family asset. It's not just your asset, it's your and your wife's asset and your future children's asset. That's why it's in a trust.
You reckon that can 6 months?
The deposit rolling concept, where you put a deposit and take it out, can happen in 1 month. Because I've funded Jodie Place, I think, with Westpac. Now Westpac won't roll it, but if I take it to ANZ, they'll do it to me today. So if you jump bank, you can do it in a month. I can't be bothered. I just stay with Westpac. I've got a 5-year contract. And they know I'm seriously there long-term because I'm taking long-term contracts. But if you want a deposit roll quickly, you just jump bank. Here's my valuation, I own the asset. Sure. But 6 months with the existing bank is the rule. And that's generic, sort of long-term thing. So dealing with the banks, use a broker. And I sort of loosely label a broker a loan advocate. It's a person that acts for you with the banks. And they'll go to multiple banks and put in split loan structures, as they should do, if they're good brokers. Now we've got a guy here called Chris Pedersen, he's really good. He's on the floor, separate company to us, but very, very good. And I use him as a broker myself. There's another guy around the town that I like, David Windler, who hangs out with property tutors. Both of those are very good brokers. If you want to come here and use Chris, who's on the floor, often we're getting contributions of up to $2,000 for the bank for you. And that can help pay for you to set up structures or settle the purchase of the property. So not only do they get you better deals and put in the split loan structures, but they get the banks to give you money. Now, if you go to the bank and say, oh, what will you do for me? They'll say, oh, we're going to give you a special deal. Our most expensive interest rate and some god-awful TV that you don't want. So these commercial guys, they're acting for everybody in town that have got some money. The banks know them. They get the respect of the banks. If the deal's hard to do, they know who to call for hard to do deals. There's no 20% money around at the moment. Sorry, there's no money for leveraging over 80%, but yet I've seen Chris banking stuff over 80%. So it is there. Just got to know who to call because they do have a discretion. So in terms of structuring your loan, do you go interest only or principal interest? Principal interest is paying the loan off, right? Interest only is where you don't pay the loan off. Interest only? So expand on that. Why would you go interest only? I don't think there's a right or wrong answer to this, but it's an interesting question that you'll have to answer when you invest. So interest only? Maximising your tax benefits, yep. And you're trying to make your money out of the capital growth. So the concept is, why pay the property off? It's not actually making you any cash flow richer to pay the property off. It's taxing your cash flow, and where you really make your money is out of the gains. So what about if you're a high income earner and you've got 10 grand a month spare cash rolling in the door, or 5 grand a month spare cash rolling in the door? What happens in those households? I'm talking to the engineers and the doctors and the professionals in the room, or the business people with good incomes. What happens? You have a wife. Go on. Go on.
She spends it all.
She spends it all, yeah. I'm just as guilty as my wife, I have to say. So I find a good way to solve this affluenza which creeps in, which is the new bag of golf clubs, the upgrade of the car, the second car, the garage to house the second car, because you didn't see that coming, the boat upgrade, 2 boats. Oh my God, how did that happen? We need to sell 1 boat, but we can't. But we did buy the second boat. That's affluenza, right? And it canes your financial goals of savings, and it really hits your retirement plans. It's bad for it. So a good way to stop it is to put all your loans on principal interest if you've got spare cash. Banks are happy, and actually you're absorbing the cash into your portfolio, which is quite efficient. But if you've got debt on your family home, you put your family home on principal interest, pay that off because the debt's non-deductible, and you leave your investment portfolio interest only. And then when your family home's paid off, which is the bad debt, it's not tax deductible, if you've got spare cash, start paying off those properties that have debt. That's something we think is a good habit at GRA. If you get into trouble, switch back to interest only. You've got a bit of capacity. If you want to get the money back, reborrow it back. The banks will be impressed you've been on principal interest across your whole portfolio. You're a great borrower, we'll give you some more money. You're the sort of person they want to deal with. Don't be afraid to pay debt down if you've got the capacity to do it. Wrong tax structure. Put your home into a family trust that you're renting out, can't get access to your tax losses. Another way to go is to put the rental property in your name with your spouse. Bad idea. Because maybe your spouse is not working, so if there's tax refunds, they can't get losses. They can't cash the losses up. Over time, you'll want to change the owner of the property, probably to a trust, because it'll become tax positive in time. When you do that, what do you have to pay when you transfer it to a trust? Tax on depreciation recovered, because when you move a property you have to pay tax on depreciation recovered. Secondly, you have to pay the lawyer for conveyancing. So you pay to sell it in your name, then pay to move it to the trust. So these are obvious things that are going to happen. Instead, put the rental property into a company. When you transfer the shares, you don't suffer depreciation recovered in most circumstances, and you don't have to pay conveyancing. If you've bought 10 houses over 10 years, you transfer the shares to the trust, no legal fees, just a share transfer, and no depreciation recovered. In terms of tax efficiency, if you use a look-through company, which is an ordinary company that makes a tax election, the losses flow through to the owner of the property. The owner then claims the losses from IRD and gets a tax refund back. So most people these days, we recommend if they're salaried investors to use a look-through company. So this is how the structure typically works. You're the working spouse, you put all the shares in your name. Let's say that your overall portfolio's got 15 grand of losses. Your spouse doesn't have a shareholding, so that you can pay your spouse a salary to manage the portfolio. Your spouse has got no income, they're a homemaker. So if this is your situation, because your spouse is not a shareholder, you're allowed to pay them a spouse salary and get a tax deduction for it. Now if your spouse has a shareholding, you're not allowed to pay them a spouse salary and get a deduction for it. So that's a trap. Lots of accountants are falling into it because these LTC rules are new. So you have a spouse salary out to your spouse, you give them perhaps a $10,000 salary to manage the portfolio, they pay tax of say $1,500 on it, you then claim it back at 33%, receive $3,300, pay $1,500. Is that good? Is that good? Receive $3,300, pay $1,500? That's because your spouse is paying tax in the first 10 grand at around 15% and you're claiming it back at 33%, differential tax rates. So to get that salary split, if you're in a position to do that, if your spouse is not working or if you have different tax rates, you've got to make sure that your spouse doesn't have a shareholding. That's an example of how LTCs can be used to an advantage. Of course, your home goes into a family trust, and over time, and the losses come out to the shareholder, which is you. So you're claiming the losses at 33, you're getting a spouse salary, you've got asset protection. Over the top of this, you're putting your split loan structures with the banks. So we've got asset protection, we're managing the banks, no bank traps of cross securities, we're maximising our tax efficiency, and we know that in the future, when we sell down some of the portfolio and become tax positive, we can sell the shares to the trust, not pay the lawyers for conveyancing, not pay depreciation recovered. Good? Simple stuff. If you're self-employed, don't do that. Got different things for you guys to do, smarter things. Salaried and self-employed people do different stuff, but tonight we just have a basic property investor structure for a salaried person. Question?
Does it only work with your spouse or other family members? Can also do that?
Does it only work with spouse or other family members?
Can you use other family members or only spouse?
Absolutely you can. I've got another structure for that, but I think this is bespoke. So I throw an example up, it's generic. We tailor it to your house. You fill in these forms I've given you out, you come see us. Good thing about these workshops is you can come and see the professionals here at GRA for nothing. Okay, those are free meetings with the professionals. So you sit down with us and we see if we can add value to you. And if you think we can, we sell ourselves to you, join us as a client. Very good way to find out whether this stuff's going to work for you. You can see Steve, you can see us. Equity partnerships, this is where your mates might come in, your family might come in. Two imperfect borrowers in this environment can't borrow. One guy's got a really high income, but he's got no deposit. And low equity rules, you need 20%. Other guy's got a deposit of 20% but no income. He can't borrow either. Get them together, and maybe it's partners, maybe it's family, form an LTC, you can have up to 5 shareholders in them, split the property between 2 or 3 or 4 or 5 people, and you're splitting the risk, you're splitting the losses, and two imperfect borrowers together become quite powerful. So combine your strength in investing. To do this, you need really good shareholder agreements, okay? You need people to give you a hand with the shareholder agreements, and we can do that. So here's an example of it. I looked through company LTC for short. Shareholder 1's got deposit money, 100 grand say. Shareholder 2's got a really high income. So they take half the company each. One puts the deposit in, and the other one signs the guarantee with the bank. Together they can now borrow. This guy says, hang on, I put more in than you. So you might agree to pay him 5% on his money and then split the gains 50-50, something like that. Now these two guys are deposit providers and income producers, but they're clueless, utterly clueless in property because they're green and they're really nervous. But they've got a mate who's really good at it, but he's got no money. But he's a property finder and he's a tradesman. So they throw him in the mix, and now he's the rehab guy and the finder. And you've got a team of people that can build quite a good company together. That's the concept of a partnership or a joint venture. That might work for your household, who knows? Just trying to give you ideas. Where do we find the deals? We talk about the 6 Ds. Divorced people. We've got one particular client in the client base that's quite sad, but it's kind of amusing. Even half of the families can see the amusement and irony in the situation. His wife hates him, his ex-wife. Man, does she hate him. And she has told him and told me that she would rather see every dollar wasted and the family bankrupted than her bastard of an ex-husband to get $1 of it. She's seriously annoyed. And they had eight rental properties, and she does everything possible to frustrate and to destroy value of the properties. And it's been going on for 2 years. Now, you do have legal redress to stop this stuff, but the cost of the lawyers trying to stop it seems to exceed the benefit that you would get out of just selling the things for the distressed price. Divorced people sometimes are very dysfunctional, and we've got an example of it in the client base at the moment. And so that's why people will tend to look for value through that process. It gets to a point where two people are just sick of each other normally, and they just say, yeah, just sell it, get out of there. So they won't try and optimise the exit value because there's too much emotional stuff going on. So sometimes you can get a very good buy out of a divorcing situation. Dumb people. Maybe they're smart, but they're just dumb on this transaction, you know. They were living overseas and they're not aware that Auckland's in a property boom because they're in some part of Europe that's not booming, Spain. And they just say, yeah, just get rid of it. The sky's falling in. It's a hell of a life I'm having right now, just get rid of it. It's a dumb decision in the context of the environment. They're uninformed. You can get good deals of people that are not informed. Dead people. Why are they typically dysfunctional in the way they sell their properties? You think about it, 6 people inherit a house, they've got taxes to pay, rates and so forth, they've got insurance, they've got tenants to manage. Half the family thinks property's a great idea, half thinks it's a terrible idea. Nobody wants to put any money in because they know the other ones are not going to put their money in. The lawyer's sending them bills. It's a very dysfunctional environment, often, some houses, some households. So you can get distressed property sales in that environment, reasonably often. The bank, not in this environment. Mortgagee sales in this environment. As I said before, the bank puts the property out. Everyone knows that bank mortgagee sales can give you a discount. The whole town turns up to buy them. That strategy is awesome in a recessionary environment. When you look for the leaky apartment the banks won't lend money on. Nobody's buying that stuff. You're the only guy. And you rock in with a silly price, 40 grand. Okay, that's the bank. But the bank, you've got to be picky with your timing, because quite often mortgagee sales actually sell for above market, I've found. It's not good. Developers need to pre-sell usually 50 to 60% to get funding on the development. They'll often let the first 10 or 20 or 30% go at a bit of a discount. So you can get, and the other thing about off the plan sales is the market's rising and you've only put a 5 or 10% deposit in. So if you're first cab off the rank, you get it at a cheaper price, the market's rising while you're waiting them to build it. By the time you get to completion, you can get some good gains. You've got to pick your timing and you've got to pick your developer. Some of the developers are dogs and they know that the price has risen, they cancel everybody's agreements and develop it in a separate entity and take the gains. I've had that happen to me.
I had a development happen across the road from me, and it started off like that. You
Yes.
got to the topping when you had 20% less, and you discounted those. Just to
say,
and everybody else's property that they bought, suddenly, boom, they lost like 20, 30 grand.
so the gentleman saw a property sell 80%, got the last 20 and he liquidated the last 20 to get out, which crashed the values of the people that bought the first 80%. Can happen, anything can happen in property. He probably had some cash flow pressure elsewhere to do that. Yeah, so it can happen. And timing of the market, did it happen, did they buy in 2006, 07, then he built them in 2008 and the market was crashing around him? Is that what happened, or you have to look at the timing and his individual circumstances?
Development issues there. Yeah.
Had some development issues, yeah.
Yeah.
Often it's the bank saying you must do this, you know. So the bank is in there somewhere. Do-ups, most common way to get equity, buy a property, do it up, revalue it. That's what I'm doing, isn't it? Raleigh Street, that Flatbush House, Jodie Place, Shirley Place. You know, those three in the last 12 months odd. They're do-ups. Buy them, do them up, revalue them. Raleigh Place, all of those properties, same strategy. So our mantra, we're all born equal, just some of us get to live a little bit better along the way. And, you know, you might want to get involved in this activity, perhaps so you can live a little bit better along the way. That's something we would encourage you to do. You might say to yourself, what can I do next? And there's a number of things you can do with Gilligan Row. First thing is, Janet's Property School is super value. It's a 6-week course. The first seat's $399. And if you want to bring your spouse for the second seat, that's another $99. So for rounding it up, $400, you get a 6-week course. You get Janet's book on family trusts and Money Secrets 101. And you get a 6-week course with Janet. It's a very, very good course. Give you all the basics in property, financing, structuring, a session with Steve doing some financial planning. You know, a very good starter course. Second thing you might do is a financial planning and coaching. By the way, I think that next property school presentation just starts in early February, so we've got some seats available for that. So if you're interested in that, fill the form in and tick that box there. If you want to see Steve and have a preliminary discussion about financial planning and your affairs, which is a AFA meeting, you can do that. Those meetings are typically 45 minutes to an hour, and that's free. If you'd like a finance meeting with one of our brokers, remember those guys get you $2,000 contributions, up to $2,000 from the banks, and they're your advocate. They get you the lowest interest rates. And most importantly, they're putting in those split loan structures. So it's free to see Chris or one of those guys. If you want your tax structures checked, I've talked about tax this much tonight, but we're a tax practice and chartered accountants. Often, people sit down with me, more than often, most people who would sit down with me, I'll find things that they're not doing that are pretty obvious and say, hey, here's some tax benefit that you can get because your current advisors are bookkeepers, they're not tax specialists. Let's change things. And while we're at it, let's make sure your estate is right and your asset protection is good. So we'll get the tax and the legal stuff fitting together. And if you want to have a preliminary meeting to discuss the sorts of ideas we would have, which is, you know, huge value at free, sit down with John Rowe and myself for free and do that, tick that box there. If you're interested in having a property accounting firm behind you, Gilligan Row are certainly very good at that area, and we'd love to be your accountant, so tick that box and we'll give you a quote. And the last thing is we've got very good property managers that we're hooked up with. If you are currently having problems with your manager in Auckland, we've got good associated property managers. Tick that box there. So if you fill that fill that form and give it to me tonight, I'm going to give anybody that gives me that form tonight a book on family trust from Janet, and there'll be a reward for taking some action and coming seeing us. So free meetings with the advisor group and no obligations for any of it. I think that's good stuff. Here's our flow.
We've got a different form to that one.
Have you? I'm going to have to give myself an F. Can I see your form? Thank you. So you can see Steve, you can see the tax structures, you can go to property school.
Oh yeah, it's the same. It's just we've got money meeting at the top instead of property.
Right.
We've got the tax structure.
Yeah, but the meeting's on free on ours. They cost $50.
Oh. Well, that's better. It's much better. Greg will have to edit this out of the video. The money meeting, yeah, we just, we'll call that free. Just cross it out and put 0. And yeah. So I'll honour what I'm saying here, obviously. You're welcome to all of this. There'll be no charge to you.
He's going to be kicking himself and then show up?
Yeah, he'll be kicking me, more specifically. The only thing that's not on there, from what I can see, is the finance meeting. Yeah. So if you're interested in accounting, we're gonna explain that to you in the tax structures meeting. But if you just want accounting, tick tax structures and write accounting only, okay? And the finance stuff, if you want finance, in the comments section, or just on the form, write finance meeting. And if you just want property management, just write property management on the form. So apologies, we're a bit disorganised tonight. I'd like to blame someone else, but I think it's me. Thanks. So what can I do next with GRA? You can pick one of those meetings. Now, do we have any questions? No questions? No? Somebody mentioned gifting down the back earlier as an issue of moving your assets to trust. And that has changed, yeah. Because once upon a time you would have to pay gift duty on the transfer of wealth to a trust. And now you can just lump sum gift and there's no gift duty, it's been repealed. However, if you lump sum gift to a trust, then rest home fees look through the trust and take everything in the trust. So while there's no gift duty, the Ministry of Social Development administrate aged care subsidy. So sometimes it's still prudent to keep gifting on a gifting program to avoid your kids getting robbed for the cost of your rest home fees. Now, funnily enough, the maximum amount you're allowed to gift as a household is 27. So it's $13,500 per individual in the house to ensure you've got eligibility for aged care subsidy. So who's got a trust in the room? Quick show of hands. So if you guys have been gifting 27 per spouse, which is 54 per year, rest home fees now grab the second gift of 27. They've retrospectively rewritten the rules. So there's no tax issue from a gifting perspective, but from an aged care perspective, a lot of the trusts that was set up, the Ministry of Social Development have effectively grabbed 27 grand a year out of gifting programs.
Can you fix it?
Can't fix that. Well, we can have a go. Sometimes we can. You know,
So one person
out of the box solutions. Like, for example, I had a guy with 9 million in the trust, and the trust was 78 years old, so it was going to vest in 2 years, and he didn't want to have to re-gift, and but he wanted the asset protection. So if the 9 million came out, it wouldn't be protected, and he was terminally ill. and his wife was a bit younger, quite a bit younger, and it was very easy. I vested the 9 mil of assets to him, and in a will left them back to a new trust, because there was no estate duty and no tax on estates. So instead of trying to run a gifting program, we just used his death to whack the money into his new trust and restart the trust. Pretty extreme tax planning, that example. But, you know, we look for out-of-the-box solutions. That might be an example of it. Well, thank you all very much for your time tonight. Do appreciate you coming along. If you'd like to come and see one of the team, I'm going to give you a book. One of Janet's books now. Actually, she's the one that's going to kill me for giving her books away. But if you'd like one of these books, hand the form to me. You're welcome to join us now for a cup of tea and a cup of coffee out here. And thank you all for coming tonight. Hand me the form, I'll give you a book. Cheers, thank you.